Dear students, today we are going to do another practical problem based on incidence of tax. Before doing the problem, let me remind you once again the rule of incidence of tax. Income received in India. It is taxable for ordinary resident, not ordinary resident, non-resident. Income deemed to be received in India. Taxable for ordinary resident, not ordinary resident, non-resident. Income arising in India, taxable for ordinarily resident, not ordinarily resident, non-resident. Income deemed to be arising in India, taxable for ordinarily resident, not ordinarily resident, non-resident. Income arising outside India from a business controlling in India, then it is taxable only for ordinarily resident and not ordinarily resident. Income arising outside India and business controlling outside India. In such a situation, it is taxable only for ordinary resident. Income earned outside earlier, brought or remitted to India during the previous year. It is not taxable for ordinary resident, not ordinary resident and non-resident. Okay, now let us read the question. Mr. Amar Singh, settled in Australia, has the following incomes during the financial year 2019-20. Income from agriculture in Australia, remitted to India rupees 2 lakhs. Income from agriculture in Punjab, received in Australia rupees 4 lakhs. Income from business in Australia, received there rupees 12 lakhs. Income earned from another business in Kuwait, business being controlled from India rupees 1 lakh. But rupees 25,000 received in India. Dividend from an Indian company rupees 50,000. Dividend from US company received in Australia rupees 2,50,000. Royalty received in Australia from Mr. Kishore, who is a resident in India, provided for a business in Australia rupees 3 lakhs. Profit from a business in Delhi controlled from Australia rupees 7 lakhs. Profit on sale of a building in Delhi rupees 15 lakhs. The building was sold to his friend in Australia, an amount received in Australia. Profit from business in Maldives. The business is controlled from Delhi. 50% of the profit deposited in a bank there and 50% remitted to India, rupees 5 lakhs. Interest received from Mr. Ajit Singh on a loan provided to him for a business in India, rupees 2,40,000. Compute gross total income of Mr. Amar Singh if he is ordinary resident, not ordinary resident and non-resident. In the last class, I have told you when you get such a question, you have to draw a table and insert columns like this: serial number, income details, and 3 columns for ordinary resident, not ordinary resident and non-resident. Okay, first statement. Income from agriculture in Australia remitted to India rupees 2 lakhs. That means income is arising outside India. In such a case, it is taxable only for ordinary residents. So you can write rupees 2 lakhs in the column of ordinary resident. Next one. Income from agriculture in Punjab received in Australia rupees 4 lakhs. That is, income is arising in India because Punjab is a state of India. We have already studied that there are certain exempted income under section 10. Agriculture income arising in India is an exempted income. So you can write in 3 columns, it is exempted, exempted and exempted. It is exempted for all the 3 categories. Next one, income from business in Australia received there rupees 12 lakhs. Income is arising outside India. It is only taxable for ordinary resident. You can write 12 lakhs in the column of ordinary resident. Income earned from another business in Kuwait, business being controlled from India, rupees 1 lakh, but rupees 25,000 received in India. So if any income receiving in India, it is taxable for all the 3 categories. So to avoid confusion, you write 25,000 in ordinary resident column, not ordinary resident column and non-resident column. And the balance amount is 75,000. So again read this. Income earned from another business in Kuwait, but that business is controlling from India. In that case, it is taxable only for ordinarily resident and not ordinarily resident. So this balance amount of 75,000 you can write in ordinarily resident columns and not ordinarily resident column. Next one, dividend from an Indian company rupees 50,000. Again, it is an exempted income. If dividend is receiving from an Indian company, that is an exempted income, you can write as exempted in ordinarily resident, not ordinarily resident and non-residents column. Next, royalty received in Australia from Mr. Kishore, resident in India, provided for a business in Australia. That means income is arising outside India, so it is taxable only for ordinarily resident. So you can write 3 lakhs in the column of ordinarily resident. Next, profit from a business in Delhi controlled from Australia. That means income is arising in India because business in Delhi. So write 7 lakhs in 3 columns: ordinary resident, not ordinary resident and non-residents column. Next, profit on sale of a building in Delhi, rupees 15 lakhs. The business was sold to his friend in Australia and the amount received in Australia. Again, the income is arising from India. So you can write 15 lakhs in ordinary resident column, not ordinary resident column and non-residents column. Next, profit from business in Maldives. The business is controlled from Delhi. 50% of the profit deposited in a bank there and 50% remitted to India. Ignore this remittance case. Okay. Then profit from business in Maldives and business is controlling inside India. So it is taxable for ordinarily resident and not ordinarily resident. So you can write 5 lakhs in the column of ordinarily resident and not ordinarily resident column. Next one, interest received from Mr. Ajit Singh on a loan provided to him for a business in India. Income is arising in India. So you can write 2,40,000 in column of ordinarily resident, not ordinary resident and non-resident. Now what you have to do? You have to add 3 columns. When you add, you are getting gross total income of Mr. Amar Singh. If he is ordinarily resident is 49,90,000. If he is not ordinarily resident, 30,40,000. And if he is non-resident, it is 24,65,000. Hope you understood this problem. If anyone is having any confusion regarding the rule of taxability, please watch the previous videos regarding the theoretical framework of incidence of tax. Thank you.